We'll start that. We'll finish it, but we'll start it. Okay, today, so let's jump back into the Chapter 3 ethics handout. And okay, independence. So employment interests of family members and close relatives. Okay, so this is, so last time we talked about what happens if the CPA someone goes from the CPA firm to the client or the client to the CPA firm. Okay, now what about close relatives? You recall those are our parents, siblings, brothers and sisters, non-dependent children, friends. Obviously, we know what friends are. Need to explain that. But and family members and close relatives cannot occupy, and this you'll remember this from last time, key financial positions. Oops. Oh boy. So family members can occupy key financial positions. So just like we did before with um, issuers, that you cannot occupy a key financial position unless you've been off the audit for an entire audit cycle. The same thing, key financial. So close relatives and family members cannot occupy key financial positions. And again, we're talking about this will be, let's put my, I'll put them in right here. So we're talking about parent, siblings, non-dependent children. That's probably most of them. Okay. Sam is a member of the Up One Corp audit engagement team. Okay, so he's a covered member. Oops. Is Sam in violation of the independence rules?
Yes.
Yep. Yeah, key financial position, close relative, the mother. So yes. Mary is a member of the Up To corporate audit engagement team. Mary's father is director of design at Up To. He's a covered member in the audit engagement.
No.
Nope, she's not. And this is fairly new. Oops. The old wording for this used to be say key position. You know, so any key position in the company, but they kind of relaxed that a little bit and they said, okay, it's only people that can affect the financial statements. So key financial position is what they're looking for. So this is one of those answers that has changed from the past. So it has to be a key financial position to be a no-no. If it's a different key position that has nothing to do with the financial statements, it's fine. And I assume the director of design doesn't do anything with the financial statements. If the director of design does, then it's a problem, but that wouldn't seem like it. Okay. Now, we do have rules for the other people that are not covered members. So we have all these rules so far have been for covered members. covered members can't do this, they can't do that, they can't do this. Okay, now the question is, what about these other people? What about these people that are not covered members? Can they just do anything they want? I mean, what are the rules for them? And the answer is no, they can't do it whatever they want. They do have some rules for them. So we will go through what these are. So these are talking about the other people who are not covered members. What are the rules for them? They can't just do anything they want. And so here's the rules for them. Financial interests. Non-covered members cannot own more than 5% of a client. So financial interest. So they can directly own stock, but if the stock is more than 5%, they're in violation. And by the way, if that happens, then the entire CPA firm is not independent. So they cannot own more than 5% of the client. Now, for publicly traded companies, it's probably not, probably not that big of that likely of a problem. 5% of IBM is, you're probably a billionaire. You probably own islands somewhere or something. So for publicly traded companies, it's probably not that big of a deal. But for companies that are not publicly traded, it very well could be a deal. Some family that owns grocery stores. Maybe they own 9 grocery stores, let's say. And kid goes off to college, gets their accounting degree, works with a CPA firm, comes back, maybe they own 10% of it. Well, they can't do the audit. Even though, the child's not working if they own more than 5%, the entire audit firm is not independent. They can't take the audit. Again, for publicly traded companies, it's probably not a problem. Smaller companies could be. Okay, employment interest. They cannot own non-covered members changes the okay, so non-covered members cannot get upper management positions or be on the board of directors for a client. And by the way, both of these, I should mention, both of these are during the time period of the audit. And what I mean by that is, so for instance, the financial interest. suppose that one of the children had 10% interest, but they got rid of the interest, sold it to a family member or whatever. If they didn't own it during the time period of the audit, that's fine. So maybe if they sold it 3 years ago, you're doing an audit this year, that's fine. Same thing with employment. Okay, my mom used to be the an upper management at this company. If she's no longer in upper management at that company during the period of the audit, it's fine. So we're only talking about during the period of the audit. During a period of audit, they cannot have 5%. During a period of audit, so for instance, 2024, they cannot have occupy an upper management position. So it isn't just of all time, it's just, for the time period of the audit. Okay, James is a senior auditor for a CPA firm that audits IBM. However, James is not a covered member for the engagement team. Okay, so he's not a covered member, so non-covered member. James is also an ordained minister and recently accepted a position on IBM's board of directors as a spiritual director. James is not on the audit committee at IBM. Will James' position impact the CPA firm's independence?
No.
Yes. Cannot be on the board of directors. Now, everything I'm sure is on the up and up, but at the same time, remember that part of the biggest thing we give is credibility. So if it came to someone's attention that you had someone for the CPA firm was on the board of directors, that's a problem. I had a student in a class one time that worked for a non-for-profit, and someone on the board of directors on a CPA firm and decided that I'll tell you what, I'll donate an audit to the non-for-profit. You can't do that. You can't, if you're on the board of directors, you can't. And they actually went through and did the audit, and it was rejected by the banks, and they were ordered to do another one, an independent audit. So, even that, even if it's a not-for-profit or something like that, you can't have anyone on the board of directors. Okay. Past due direct professional fees. Unpaid fees by a client. Create a creditor debtor, how you pronounce that? Let's give the CPA firm a direct interest in the client. Let's take it on the end. Okay. Unpaid fees. They create an independence problem for the CPA firm. So if the client hasn't paid their professional fees to the CPA firm, this will give the CPA firm incentive to give them a better audit opinion so that they can get the money to pay them. So this will be a violation of the independence rules. So if you have unpaid fees, you cannot take the audit. Any question on that? And again, it's almost like as if you loan your client money. This is sort of like a loan to the client. Becky, okay. Which one do we have here? I thought we were almost done. Doesn't look like it. Oh, okay. You know, I thought I got rid of this at the end. Okay. All right. Other independence issues. Gifts are allowed if they are one. Oops. New word I just made up. Clearly immaterial. Or two, appropriate in the circumstance. And I'll talk about that one. So gifts are allowed. So you can take gifts from the client if they are clearly immaterial. Your client gives you a hat, they give you an IBM hat or something, whatever it is. You go, okay, that's fine. Don't want to be rude and say no, thank you, but so they're allowed if they are clearly immaterial. Or, and here's the trickier one, appropriate in the circumstance. I call this the golf rule. I'm the only one that calls it that, by the way. Don't look for that. Appropriate in circumstance. Say golfing rule. This is kind of a cultural thing, mostly for the United States, also some Asian countries. Golfing is big in business. And by the way, if you're going to be if you're going into a CPA firm and you're going to be you want to move up to be a partner or something like that, you're going to have you're going to have to join golf clubs. A tremendous amount of business is done in golf clubs, and companies will have golf outings, and they'll invite their CPAs along to the golf outings. Now, these green fees can be pretty steep; they can be thousands of dollars. So, while it wouldn't necessarily be immaterial dollar wise, it would be appropriate in the circumstance. By the way, international standards generally don't allow this, although there are some Asian countries that do this also, that have kind of a culture of golf. Yeah, it's also almost all of it's for golfing. It's I guess they could do other things. They could go like on a sailboat outing or something like that. But golfing is huge. Yeah. When you become a partner, you'll join at least one golf club usually to take clients, and that's how you get business. Okay. So they're allowed, and again, clearly immaterial, so they give you something that isn't worth that much money. We don't use the IRS standards, but clearly immaterial to whatever the auditors, and appropriate in the circumstance, and that is generally the golf rules. Okay, litigation. Problems with litigation come in a couple of things that can make you not independent. Litigation. Lawsuits with the client. Let me put something on here first. Oops. So if you're in a CPA firm lawsuits with the client, so if you're suing them or they're suing you, independence could be compromised. Second, lawsuits between clients. For instance, if you had, let's say that you had IBM for a client and you also had Microsoft, maybe they're in some lawsuits with each other. They probably are. uh, so independence may be compromised if the CPA firm has a lawsuit with a client. Either they sued you or you sued them or you cross sues or whatever. And lawsuits between clients. You may have to pick one client or the other. Remember that you have confidential information available to you, and that confidential information may be advantageous to the other client, and it would put you in an awkward situation that even if you didn't, if you didn't disclose anything of either one of them, you may be called out by both of them on behalf of each other, and you may be, call them to court on both sides of an issue. And so you could run into a place where the independence um, would be troublesome. We come in, and again, that's if there's lawsuits between the clients that you have. They're not suing you, but they're suing each other, and you have a fiduciary duty to both of them. Okay, non-attest services. I'm going to cover this later. I keep meaning to take this out. Covered below. I've done this many times, and I keep forgetting to take this out. You know what? I'm going to write it down to remember that. Take out. It won't help you guys, but you're the last class that'll have to endure my goofy handout. Reporting illegal acts. First of all, only material illegal acts only material illegal acts are in the audit report. Okay, so only illegal. So again, when it comes to the audit report itself, material illegal acts are only material ones are we concerned about. We do not change our audit for immaterial illegal acts. Okay. I should say illegal acts may be reported only to management. significant illegal acts, significant or material, I should say. By definition, material is significant. Material is significant. So this is the AICPA rules. I should have put that in here first. So these are for non-issuers. PCAOB. Okay, PCAOB and issuers. I believe, and I'll check this to make sure I'm saying it correctly. I'm virtually positive I have this right, though. All illegal acts are reported to the board of directors and the audit committee. I think this was a new rule that came out a couple of years ago, maybe three or 4 years ago. And I'll tell you why. Because immaterial, while it can be, to say something's immaterial to say IBM, it'd mean a big chunk of money. So you could have an illegal act that's pretty high dollar amount, even though it's not material. A $50 million illegal act. It's not illegal. It's not probably not material to IBM, but it's big. And the board of directors should know about it. So the new rules are that you report all illegal acts to the board of directors if they're issuers. All right. And so it's gonna be long. Let me think here. How am I going to do this? Reporting illegal acts. Illegal act follow up for an action. So what happens if you give somebody something about an illegal act and they don't do anything with it, and you think that they should? Okay, first rule. I just say law enforcement. You have a fiduciary duty to your client. Part of that fiduciary duty is that you do not do anything that's not in their interest, and going to law enforcement may very well be, no, don't do that. Detrimental to your client. So you do not go to law enforcement. So you find an illegal act and the company does not do anything with it, and you think they should. All right. We have two different rules. AICPA, non-issuer. And this is going to sound like a complete cop-out, but get a lawyer. Because now you know of an illegal act, and as a professional, you have a duty to report some illegal acts if you're a professional, and that's for all professionals. For instance, when you get a CPA license, it's like a doctor's license or a lawyer license or in these other therapy licenses and all that kind of stuff. You are required to report any abuse to children and elderly. The general population is not under that, that legal aspect, but if you're a professional, you are. So there are some illegal acts that are in the general interest of the public, and you are required to follow them, even if the general public is not. And this is where you get into a sticky area. You know of an illegal act, yet it's your client. You have a fiduciary duty to your client. So you don't just go to the authorities. And if it is a non-publicly traded company or business, you generally have to get a lawyer because it's a real sticky ground you're on, of what to do next. Now, if it is a publicly traded company, oops. So for issuers, now you have a distinct legal requirement to if nothing is done within 24 hours, you need to contact the SEC. And by the way, yes, you will tell the client, look, you got to do something or else we're going to the SEC. So non-issuer, get a lawyer. PCAOB, you give some illegal act, they're not doing anything about it. If no action taken in 24 hours, you contact the SEC, and they're very strict on that. They want to know immediately if there's an illegal act and they're not adequately addressing it. So it is a little bit better if you are with an issuer, because the whole legal problem fades away. You're required to. Okay. So Pete, what time is it? Oh. This is a really long, this is a long, like real nitpicky chapter, but it's a huge part of the CPA exam. So I know it's tough to hang in there. It's this, but not this, and you can do that, but not that, and this person can do it, but this person can't. But this is literally like 15% of the CPA exam. I think up to 20%. So while it is a little bit nitpicky and it's that way for a reason too. It's that way because credibility is everything. So this whole independence and ethics thing is massive, because without it, we're not in business. There's, all we lend is credibility. So all this stuff is really important. Okay. Auditors. Must comply with valid and I'm going to put only. We only have to deal with subpoenas. And what I mean by that, a lawyer sends you a letter saying they want this information or that information, forget it. They got to go to court. They got to get a court to say that they to issue a subpoena. It must be a subpoena. It cannot be a lawyer letter. The IRS sends you a letter, throw it in the garbage. You don't comply with those. If the IRS goes to court and gets a subpoena, then you comply with it. But until they do, so it must be a subpoena. It must be a court-issued subpoena. And I think that even in some states, they're actually giving some protection against even subpoenas. But I'm not sure how many states there are like that. But so in general rule, though, is if it's a valid subpoena, you have to comply with it. If it's not, ignore it. Okay. The auditors uncover evidence that they're publicly traded. Okay, that's important. They're an issuer. Don't goof it up. Publicly traded company, so they're an issuer. Routinely violate the Environmental Protection Agency laws. When presented with the evidence, the client's management and board do not respond within 24 hours. In this scenario, the client should do which of the following? Oh, come on. I just talked about this. I know you guys are. Yep. Yep. You have 24. If they don't do anything in 24 hours, you immediately turn it over to the SEC. The auditors uncovered that the CEO of a publicly traded company routinely parks his car illegally in handicapped spaces. When presented with the evidence, the client's management board do not respond. This is one of those clearly immaterial ones. While you are required to report clearly immaterial stuff to the board of directors, they do not need to respond to those things for the SEC. So we're actually this is, I should probably put this in that this is for material illegal acts. I'm just going to say this just because they kind of put a complete closure on it. You do not need to know this. If the audit you're doing includes audits of government contracts or government grants, you're required to report to the government all illegal acts, whether they're material or not, related to the contract or the grant. So even if it is immaterial, it's kind of the exception of the rule is that if it's a government contract or a government grant, you are required to report it to the government. You don't have the choice of saying whether it's material or immaterial. Every illegal act related to a contract or related to a grant from the government, you're required to report. So that's the one that you don't need. It doesn't matter if it could be theoretically it could be 5 cents worth of illegal acts, and you would report it. Let them decide what to do with it. Contingent fees. Okay, let's contrast something here. Flat fees. Flat fees are for a stated remark that will not change, and these are always allowed. So flat fees are always allowed. Oops. Can change with incentives, or decentives not a word? Decentives isn't a word? Well, we'll say incentives. I thought that was a word. Maybe I spelled it really. If I spelled it bad enough, it would never. Okay, so let's say incentives. That's usually where they go anyways. Contingent can change with incentives in the contract. The, You're contingent upon certain actions. So contingent. Okay, so in other words, something has to happen for them to change. So contingent fees, and let's just talk about contingents in general. So contingent means it relies on something else. Okay, so for instance, if I go outside today, I'm going to take an umbrella if it is raining. So contingent is if it is raining, I'm taking an umbrella, right? So it's contingent upon it raining that I will have the umbrella. If it's not raining, I won't have the umbrella. So that's what a contingency is. It's contingent. It's on some situation or some action. And normally those, those things in contracts they're okay. There are 3 cases though that the AICPA does not allow you to do contingent contracts. So contingent contract means if something is met, that you get. So for instance, if you get something in, if you get this job done within a certain time, they'll give you a bonus of $3,000 or whatever it is. That's contingent. You got to get it done on time, then you get $3,000. That's a contingent contract. And there are 3 specific that you cannot do contingent fees. So flat fees always allowed. Should maybe change the color here. We'll make these Aqua. Contingent fees are not allowed for. Oops, did do something. They're not allowed for audits or other attest engagements. Now, a flat fee is allowed. Second one, tax returns. One too many letters. Oops. So they're not allowed for audit engagements and test functions, tax returns. I'm going to fill all these in and I'll talk about them in a second. And the third one is compilations, and this is making financial statements. And again, flat fee allowed. Okay, let's talk about these for a second. So you can't have a contingent fee for an audit. So if someone says to you, you say, how much will this audit cost? You tell them it's $80,000. They say, I tell you what, if we get a clean audit report, I'll pay you 90,000. I'll give you a $10,000 bonus if we get a clean report. Can't take it. It's a contingent fee. So a contingent fee you cannot take if it's on if it has to do with an audit or a test function. And if you think about it as to why, it's pretty obvious. There'd be an incentive for you to maybe give them an opinion they don't deserve, or it might, or if nothing else, people could look at that and it would not appear to be on the up and up, right? The credibility of the audit would be in doubt. Okay, so audits cannot be done for a contingency fee. Flat fee, fine. Cannot be done for a contingency fee. Tax returns. So tax returns is someone gives you, comes in and you say, okay, well, I tell you what, you don't need to pay me anything up front, but I'll do your taxes and I'll take 20% of your return. Okay, so as part of my, my fee is not going to be flat. It's going to be 20% of whatever your return, and I'll get you as big a return as I can possibly get, but because of that. CPAs cannot do that. Do people do that? They do it all the time, but CPAs are prohibited from doing it. One of the weird things about taxes in the United States is you don't need, anyone can do them. You got people that have never graduated high school that could do your taxes. There's some other countries that, for instance, Germany, you basically have to have a master's degree in tax, in accounting or taxation to do taxes. But so CPAs cannot take it on a contingency fee. We can charge them a flat fee. Yeah, I'll do your taxes. I'm going to charge you $200 and I'll do your taxes. That's fine. But you cannot do it on a contingency fee basis. Okay. The last one here is a little bit incomplete, and I'll tell you why. Compilations are simply making the financial statements. There is no assurance given to these, but if they are used for so I'm going to put some asterisks here. Generally speaking, this only applies if the compilation is used to acquire loans, acquire a loan or investors. We can charge them a flat fee. Can you do my financial statements? Yeah, but generally, if it's used to acquire a loan or for investors, or that it's going to be relied upon someone else, you cannot do it for a contingency fee. And again, compilations are just making financial statements, and you don't have to be independent to do that. A compilation, there's no assurance given. However, if it is going to be used to try to attract investors or get a loan, then you can't do it for a contingency fee. You can still do it for a flat fee. You can't do it for a contingency fee. Compilations, by the way, because you don't have to be independent, you can do them for anyone. So, maybe you're a CPA and your husband's a photographer, and he wants you to do the financial statements for his photography studio. You can do it. No problem at all. You can do you can't do an audit. You're not independent, but you can do a compilation. You don't need to be independent to do a compilation. So, if you friends and relatives and all that kind of stuff, you can do compilation for you. You make their financial statements. You can't do it for a contingency fee if it is going to be used for getting a loan or attracting investors. And the idea is that, someone say, well, if this compilation, well, I got to give this to the bank, and if I get the loan, I'll give you an extra $5,000. Well, that is incentive for you to cook the books to try to get them the loans so that you can get the extra money. So those are the only three. You can always charge a fee. So there's some students have erroneously, or I didn't explain it well, that you can't charge a fee for certain things. You can charge a fee for everything, and believe me, CPA firms will. You can charge a fee for everything. You cannot charge a contingency fee for those three situations. So for audits, tax returns, and compilations, you cannot charge a contingency fee. Flat fee is always allowed. So you can always charge this. Okay. I am going to push through here. I know I should take a break right now. I'm going to skip these three. Those are not on the test. Every time I do this chapter, I try to cut it down, and it's hard to do though. And two, I don't want to skip it down, cut it down too much because it's a big chunk of the CPA. Okay. I do want to get to this last one here, though. All right. So here we have the idea of the PCA. What are you allowed to do for your clients? So this one's for issuers. And this one will be for non-issuers. Okay, so what are you allowed to do for your client? I'm just going to kind of go through these. Bookkeeping. If your client is publicly traded, no. ACCT330, yes. So you can do bookkeeping. You can't make management decisions, but you can do bookkeeping. Financial accounting system installation, no. Yes. And the idea is, here's the basic idea behind the Sarbanes-Oxley rules. Anything you're going to audit, you cannot do for the client. Part of the audit is evaluating their accounting system. You can't put in the accounting system because you're going to audit it. You're basically auditing yourself. So AICPA, anything you're going to audit, the general rule, anything you're going to audit, you can't do for the client. AICPA is a little bit more lenient on that. Appraisals or valuations, generally no. And this is going to be yes, but only, this is kind of a weird, only if they are objective measures. For instance, stock prices, things like that. If someone says we want you to evaluate how much our stock is worth at the end of the year, you go to find the last publication of Wall Street Journal or whatever, the ending price for all the stocks that they have, objective. That you can do it if it's objective, if it only if it's the non-issuer. Internal audit functions for the client, no. Yes. Management and human resource recommendations, no. Generally not for the issue. I'm gonna say no on this one too. You generally cannot do the hiring functions. This is a management function. It is possible that you get a list of clients or a list of possible people that they can look at. So they say we want people that can do X, Y, and Z, and you can give them a list of those people, but you don't make any of the decisions or anything like that. Investment service recommendations, no. Yes, but only for allocations. And what I mean by that is you can say, okay, I'll let you should invest 10% in real estate or whatever. Legal services relating to auditing. Generally, no. And this one is yes by default. There are no rules on it. Tax planning for common issues, yes and yes. You want to know what the tax, what do we pay if we make this much income? Absolutely, you can tell them Unusual or aggressive, no and no. You cannot be an advocate for the client, which is what you'd have to be basically if they did some kind of aggressive tax issue. Individual tax services for officers, no, and yes. We are going to skip the independent rules for the international standards. They will not be on the test. And quite honestly, not to sound mean, but they kind of don't have any rules. International standards are very loose. And they're loose because of this. They basically say everything's okay as long as safeguards are applied. They don't say what the safeguards are or how you apply them, but this is the wording they use. And by the way, they're having tons of trouble with this. So the international standards are much looser than the U.S. standards, and quite honestly, they're kind of paying the price for it because they are getting real problems with independence as far as especially financial independence. But if you read through them, they're almost always, well, it depends. Well, it depends. As long as safeguards are in place, and it's okay. As long as safeguards are in place, they don't say, but they don't say what the safeguards are. So it's a little bit dicey there. And again, there have been some markets that have almost collapsed because of it. But anyway, we're going to skip that. So we are done with the chapter 3 handout. And none of this stuff that we skip will be on the exam. I'm going to shorten this thing up when I did a class today. Okay, so here's what we're going to do. I'm going to send out the multiple choice questions. We do that right now for chapter 3. I will start a poll. Hey, they moved it. I'm sorry. The reason I'm laughing is that they have additional items, and the only additional items are the polls. So, okay. So, and go ahead and take a break, come back, and when you're done, we'll start going through these, and you get extra credit points, so they get added onto your test for those. Let me see if I don't think I have. You should get it momentarily. Maybe not. Let me go ahead and pull it up on the screen. Get it? Did you guys get the multiple choice questions?
We did.
You did? Oh, okay. Well, I'm glad you guys did. I did, but okay, yeah. And so go ahead, go ahead, take a break and fill those out as you needed. And let's say be back at let's say 7:20. Give you a chance to look at them and go over them. All right, well, oh, there I go. Okay, finally. All right. Is anyone still working on the multiple choice? You can put it in chat if you want. Okay, let's go through here. By the way, these are actual CPA questions. These are go back to when the CPA exam was an open exam, and you could actually get CPA questions. And the reason I use these is that they are, well, they're actual exam questions, but also they're usually better written than the other ones, the people that did not show up. Okay. Yeah, so person started purchase stock in a client. Uh-oh. And facing the education fund, the trust securities were not material to the CPA, but material to the child's the child's personal net worth. Yeah, this is you can't have any direct C. Oh, yeah, Z add equally. Yeah, it's C. It's true that they're both that they are. It's a direct financial interest. So it's a direct financial interest, and materiality is not doesn't matter. One share of stock will knock you out. Okay. ACCT allows bookkeeping services for the client. As long as it's just plain old bookkeeping services, they're fine. Uh, A would be okay if they were with the client's approval. If the client approved all the journal entries, that'd be similar to a bookkeeping. Then A would be okay. But without the client's approval, you're taking a management responsibility. And actually, hey, that's not me. The hair looks different. What am I doing here? That's me. You cannot do any management activities for a client. So you need to have their approval, basically. Okay, on that for the journal entries. Yep. Choosing a fee. You can always charge a regular fee, a flat fee. Contingency fees are no, no. Which of the following acts by a CPA would most likely be a violation to the AICPA Code of Ethics? It is D. Now, this one, accepting a fee in a tax matter relating to administrative proceedings. If this was not a contingent fee, and if the administrative proceedings were not necessarily that it was contentious, it'd be okay. This one's a weird one. See, I understand C, and I actually agree with you that it should be. Financial forecast. I wish they would stop doing those. You guys remember from the Anthony thing, the Fleming financial forecasts are really weird, and you can actually do an audit on a financial forecast. And think about how strange that is. Auditing is generally for historical stuff, what happened last year. You do a forecast, and they actually do an audit report. The audit report is on how they prepared it, but it's still one of those things that gives assurance to something that has never happened. So I wish they would stop doing that. Financial people will claim that it gives them more information. But. All right. Fee for services, and this fee was payable to the audit of financial statements. Yep. Auditing is a no-no. You cannot get a contingent fee for an audit. And here's a contingency. Leave it alone, we'll pay you. AICPA is just a club. They can do anything they want to their members, but they cannot take away your certificate. They didn't issue it. You guys are right. Which of the following regulations would likely most impair the CPA's independence with respect to a particular audit plan on which the CPA works as a covered member? Cousin, immaterial, it's fine. Friends and relatives, actually that'd be even a stretch for a relative. B, this one's definitely a no-no. They would definitely have influence over the financial statements. C and D. This one's a little bit iffy, but generally speaking, if it's like for a bank or something like that, it'd be fine if it's at arm's length. This one, because they're not aware of it, it's fine. I shouldn't do that. It makes it look like it's the right answer. Okay, I just made it worse. All right. 8. Yeah, the weird thing about audit, about CPA firms, you must be independent. This is different for doctors and lawyers and all that kind of stuff. If you're a doctor and your kid falls on the sidewalk, you can give a medical help. But if you are a CPA, you cannot give your services to anyone you are supposed to do. Ooh, look at it, 9's all over the place. Which of the following is least likely? D. A is independent. It was a problem. The son of the president of the client. Okay. The wife, the partner, a direct. So immediate family member, they cannot have any of it. It's the same as the client. I don't do that one. Oh, I know. I just don't do it. Mutual fund, the mutual fund will have it. So D is right. I think it's the first time you guys missed one. Which of the following would, if I remember, be considered independent when performing the audit? Immaterial, indirect, mutual fund, something like that. B is an interesting one. You cannot be on the board, and no one can be on the board of directors. The independence issues for the entire audit period, and this will be January 1st through December 31st. If you were on the board in January, you're not independent. They make investment plans for the client's pension plan. Yeah, that's a management position. Okay, that's not too bad. 9 out of 10. Okay, give me 1 second. What week is it? Week 5? Week 5, chapter 3, multiple choice. Okay. Hey, my screen went blank. Okay. Let's go to, we'll start a little bit on this. No, you know what? We're not going to start on this. No, that's not yet the test. We'll start on this next class. I don't think we can get through what I need to get through on that. And besides, I think we went over last time anyways. Okay, so next thing I'm going to do is next thing I'm going to do is next thing I'm going to do is send out the exam for chapter 3. So we can turn in the chapter 3 handout. You do not need the things that we skipped. You do not need to do those. And yeah, so you turn those in, and I'll send out the chapter 3 exam. Any questions on the classical sampling? The classical sampling handout. I think is it due this Friday? Can't remember now. Let's do this. I think classical sampling is due Friday 20. Okay, yeah. And so you get the last 3 ones on that page to do. Oops. Any questions on it? Don't say anything. Oh, when is the exam due? Good question. The exam is due Friday, October 4th. So a week from this Friday. I'll send it out tonight, though. I'm going to go over it and make sure we need it to be. Okay. Any other questions? Okay. Have a good evening, and I'm get done early. Hopefully, I'll make up for some of the times we went over. But okay, I'll have the test will be out. You should send the test out by about 10 o'clock. Hopefully before that, but by 10 o'clock, you should have the test. Questions? Have a good evening.
Thank you.
Good night.